Hi, I'm Brandon Ketron here on behalf of EstateView Planning Software. And today I just want to give a tutorial of the installment sale with income tax analysis calculator, which is one of my favorite calculators. As you'll see when we pop into the software here, we're going to be able to illustrate the financial results of an installment sale to an effective grantor trust, where you would sell assets in exchange for an interest-only promissory note at the applicable federal rate, which as of today's recording is around 4.35%. And to the extent that those assets transferred grow in value over the interest rate on the note, we're then passing that future appreciation outside of the grantor's estate, while also enabling the grantor to pay the income taxes on behalf of the trust, which reduces the grantor's estate over time and is not considered to be an additional gift. But the unique thing about this is what we're really trying to analyze here is, are we giving too much away? With the grantor's personal consumption, with the payment of taxes on behalf of the trust, over time that can eat into the grantor's retained assets. And the last thing we want is a client coming back to us later on in life with no money and needing a way to pay for their everyday living expenses. So we want to be able to run numbers on, are we giving too much away? How much do we need to retain? And the installment sale with income tax analysis calculator allows us to do that. So I'll go into the calculator now, click on installment sale with income tax analysis. You can see at the top here, we have our inputs, right? So we will go through those inputs, and on the bottom, we have a spreadsheet that shows the grantor's retained estate on the left-hand side, and then the trust and its growth on the right-hand side. And you can scroll this up and down. So when we have a larger number, we're illustrating a number of years, we can expand this out so that everyone can see the inputs and the data. Or if you're trying to just focus on the actual inputs, then you have that ability to kind of minimize the spreadsheets. So what are we inputting here? What are we illustrating? Well, our general information here is the grantor's age. We have a 60-year-old individual, healthy, has $50 million of assets, and we're really looking at liquid assets here mostly. So, maybe $50 million in consist of operating an active business and an investment portfolio, or maybe it's just $50 million of an investment portfolio. They've sold their business at age 60 and are looking to retire, and now they're coming to you for estate planning. And then we have their annual savings or spending. A negative number will be spending. A positive number will be saving. So you can show savings or spending, either one in this column. The annual growth rate on the assets, I'm using 8% here. Our income tax rate on that growth. For simplicity here, this calculator just assumes that all growth is taxable in the year that it occurs at a blended capital gains and ordinary income rate of 30%, and whether or not we've used any exemption. Now we go to our, I'm going to skip over to the other information side. Our other information here is our estate tax rate, which is 40% at the federal rate. Here in Florida, we have no state estate tax, but some states do. So for example, California, I believe, has a 13% rate. So you might increase this to 53%. That can be inputted there to show the impacts of the state estate tax as well. Our consumer price index growth rate at 3%, that's going to impact our exemption amount. That's also going to impact our personal consumption. So the $700,000 of spending will grow every year by 3% to show the impact of inflation. How long is the note going to be? We're using a 20-year term here in this transaction. When we might turn off grantor trust status, -1 means simply it's never going to be turned off. It'll exist throughout the lifetime of the grantor. Or if we go to say year 10, we're turning off grantor trust status at year 10. May not be a good idea because this note's still outstanding. Might trigger some income taxes there if we turn off grantor trust status with an outstanding note. So you might show year 20 instead, turning it off right after the note is repaid. But you can change those inputs if you like. I'm just going to keep it a full grantor trust for lifetime. And then the number of years we're going to project. Well, if this 60-year-old, we're going to project out to age 95. If they want to go out to age 100, we can do that by showing another 5 years there as well, whatever you prefer to illustrate to the client, you can project any number of years. Our sell and note info. So what are we going to do in this transaction? Well, we're going to sell $25 million of assets, one half of our estate, at a 35% discount. So when you have an asset that is an LLC, it might be non-controlled, it might be non-voting, it might be non-marketable. So there's a discount that applies there on that transaction. You need to get a valuation report to confirm that discount that applies. We can't just make an assumption there, but 35% is relatively common discount that's taken and supported by many valuations that we've received over the years. And so then our $25 million asset value is actually going to be a sell value of 16.25. So that's going to be our note owed back to us at 4.35% interest. And we're going to make a seed capital gift in year one of $1,625,000, 10% of the note value to give the trust some capital to support those first interest payments, along with having capital to support actually entering into this note transaction. The IRS doesn't want to see an empty trust getting a note and in exchange for assets. They want to see some capital there to support the ability to repay that note, which is why we make the 10% seed capital gift. Our interest rate, it automatically comes up with the lowest available rate for the month that you're doing this. We know that when we have a sell, we can use either the current month or the prior to, whichever one is that we pick, but generally, the lowest rate is what we want to use. So we're here in May, we can still use March's rate of 4.35%. If you want to know where that comes from, you have the last 3 AFR rates here on the screen, but you can also look up the AFR, and this goes all the way back to January of 22 if you wanted to look back in the future and select the AFR that's applicable for your transaction that you're trying to illustrate. So then let's get into the results. So in year one, we have $50 million of assets, and still in year one, we make a seed capital gift to the trust of $1.625 million. You can see that highlighted there. Let me expand this up and zoom in on the screen a little bit so everyone can see it on the screen. So we have the initial seed capital gift made to the trust here in year one, and then also the sale of assets, the $25 million of assets plus our seed capital gift of 1.6 gives us 26 million approximately in the trust, owes a note of 16.25 to net assets in the trust of just over 10 million after year one. In the grantor's estate, without the note, it's then down to 23 million, and with the note owed back to them, it's just shy of 40 million. So then we're going on to 2025 in year two, and we can see that there's income on the assets, the retained assets here. We owe taxes on that income. We net after tax this 1.3 million number. We spend $700,000. We receive $700,000 in a note payment. And then, because it's a grantor trust, we pay the taxes on the trust growth, which is just shy of $640,000. Which reduces our estate and saves us some more estate taxes by depleting the grantor's retained assets without being deemed a gift to the trust, which is a nice benefit of grantor trust planning. And then we have our taxable estate without the burn consideration. If you wanted to just show that, or if you want to show it with the burn, it's there as well. Total taxable estate, what is our exemption amount? What is our estate tax liability? And what is our savings if we did absolutely nothing and just kept the $50 million of assets? That's all shown here. We have the trust assets, the growth on the trust assets, no income taxes paid by the trust since it's a grantor trust, the note payment owed back to the grantor, the net assets at the end of the year, and the net assets if we die in a given year. So as you can see here, as this goes over time, initially, our estate is growing in value, so you might be thinking that we should have done more when we kind of look at this 10 years down the road. But as time goes on, you can see this income taxes paid by the grantor goes up significantly in value as the trust grows in value. So that obligation is then starting to deplete the estate at around age 79, 80. We start actually turning the opposite way where the retained assets are coming down because of these large income tax payments owed by the grantor on the grantor trust. And we can see here at age 95, we've actually depleted the grantor's assets, meaning we have an absolutely perfect estate plan if the grantor dies at 95. So obviously the next question from the client is going to be, what happens if I live past 95? Well, then you can explain to them that we've likely sold too much in this transaction. Maybe we should have done less, or we should have planned for some things that we could have done to reduce that burn obligation, those taxes that you have to pay on behalf of the trust. There's things that we can do to minimize that. An easy one is we can turn off grantor trust status. So let's go back to our inputs and say, well, what if we turn grantor trust status off after we repay the note? We turn it off in year 20. You can see here at age 95, then we have plenty of assets remaining, but we also have a large estate tax bill that's due. So maybe it's not a good idea to turn it off immediately. Maybe we need to go a couple more years down the road. Let's look at age, if we turn it off at 30. Then you can see much less taxable estate remaining, but we still owe estate tax a little bit. It's not quite to our exemption amount if we die at 94. If we die at 95, the exemption has increased with inflation at 3%, even taken into consideration that it does drop in 1/2 in 2026. You can see here that it goes from 12 million down to 5 million. But it tells us that turning off grantor trust status at 30 years down the road might work out well in this scenario. What happens if they live to age 100 in that scenario? So let's illustrate another 5 years. Yep, still below the estate tax exemption amount, still have retained assets. So we're in good shape through age 100 if we turn off grantor trust status at age 30. What are some other things that we did if we don't turn off grantor trust status, and we're looking here at negative numbers? Well, the trust could actually invest in municipal bonds, so there's not a large income tax bill back to the grantor. The trust could buy life insurance that's non-taxable. So there's things that we can do besides turning off grantor trust status to mitigate, the impact of the burn on the grantor's retained assets, all of which can be, illustrated with EstateView. If we say the income tax rate is not going to be 30%, it's only going to be 20%, because a lot of the growth is going to be in muni bonds. Well, then we have a very large estate tax bill at the end, so we could actually afford to sell more in this scenario. So it allows, again, for you to kind of design the plan, keeping the grantor's retained assets in mind as you go through the number of different options that are available with an installment sale. So some other things that we can show here is we could do a self-canceling note. So if the grantor died during the term of the note would automatically cancel and not need to be repaid, which can, show some more additional estate tax savings. You need to increase the interest rate for that self-canceling installment note risk premium that would apply for the trust taking the risk that the grantor dies. So you have to go to our skin calculator to determine the rate for the self-canceling note, and then you can input that in here. For a 60-year-old, it's probably going to be just shy of 8%. So we can show a 7.5% note. Grantor dies, and let's say year 20. Or if you look at it and say the grantor dies at age 70, you can actually look at the age 70 column. You can see that that note would cancel on death, and estate tax savings would be significant over time. If the note does survive the note term, the note would be repaid, in which case you see the estate tax savings going down there in years 20 and 21. So you can show a conventional or self-canceling note. Let's go back to conventional at our 4.35% rate, not turning off grantor trust status, and our income tax rate back to 30% that we started with. And back to our illustration out to age 95, 35 years of projections where we run out of assets. So how can we share this with the client, right? It's valuable on screen, but we want to get it in the client's hands so they can look at this and analyze it and determine if this transaction is right for them. A number of ways to do that. One is we can take screenshots of the results that we see here on our screen. So I clicked screenshot button, opened up this screenshot, and it gives me my spreadsheet that's on the screen that can be shared with the client. You can also save the options screen, so this top screen as well. You can screenshot that to show the inputs that was inputted into the software. So that's one way you can share using screenshots. The other way is we can export this to Excel. So if we open our Excel file, save results to Excel there, it gives us a spreadsheet that shows the same inputs that we have on our screen, but now in an Excel format. So if you want to change the column headings, so you want to change this to like personal consumption, you can do that there. This payment would be a note payment instead of just payment. If you want to be more detailed, you can input the data there. You can change these colors. You can put your logo on it. You can manipulate some of the inputs. If you wanted to show, a different rate of growth, you can do that with Excel and then share the spreadsheet with the client. Another way to do this is we can actually share the software with the client. So if you go to the Share with Client button, there you will have a passcode. You can change the passcode to be whatever you like. If you want to make it all ones, you can do that by clicking up and down on the arrows. Or if you want to keep it like the client's birth date or the last 6 of their social, something like that, you can change that passcode. Click Generate URL. It gives you this link here. Copy it to our clipboard, share the password with the client, paste that into an email with the password, and it gives them access to this software and this calculator for 14 days. So then the client can come in and say, okay, what does it look like if I sold, 30 million of assets? I run out of money sooner. What if I only sold 20 million of assets? I have plenty of money to live the rest of my life, but I have a large estate tax bill. What if I go back to the 25? That looked like a good number that Brandon put in there for me. That's good. What if the growth rate's higher? What if the growth rate is less? So it allows the client to be to be involved in the plan and in the plan design as well, and kind of helps them make an informed decision as to what type of transaction do they want to enter into, and allows for you to make an informed decision as a planner to make sure we're appropriately advising clients on how much to give away at any given point in time. The other thing that we can do is generate explanation. That will be coming soon. You'll have an explanation letter that pulls from the data that you've inputted that will explain some of the background material behind the spreadsheet, behind the installment sale transaction, very similar to what you see in our other calculators. So we'll have that feature coming soon here. But for now, you can export this to Excel. You can send them the screenshot. You can share the software directly with them to enable them or the client to see the data, see the year-by-year results, and have a better understanding of the transaction versus what you just told them verbally in a meeting. So that is the installment sale calculator with income tax analysis. Hopefully you can use this to help you and your clients. Of course, if you have any questions on the calculator, want to know how to illustrate a specific scenario, feel free to reach out to us. We're glad to assist and help you build out a plan for a client using EstateView. So hopefully this tutorial video allows you to understand how to use the software and how to illustrate the installment sale technique to clients. And again, this is Brandon Ketron on behalf of EstateView Planning Software. Hope you have a great rest of your day.